Have you ever watched the news and heard terms like GDP, inflation, or unemployment rate and thought, okay, but what does that actually mean for me? You're not alone. Economic indicators can feel like cryptic code from a secret club of economists and Wall Street insiders. But here's the truth. Once you learn how to read them, they can become one of your most powerful tools for making smart financial and investing decisions. Hey friends, welcome back to the channel where we break down money and investing in a way that actually makes sense. Today we're diving into how to read the economic indicators that shape everything from your grocery bill to your investment portfolio. So, why should you care? Because economic indicators are like the dashboard lights of the economy. They tell you when things are speeding up, slowing down, or heading into dangerous territory. And just like you wouldn't drive with a warning light flashing without checking it out, you shouldn't invest or budget without understanding what these signals are telling you. Let's start with one of the biggest indicators, gross domestic product, or GDP. This measures the total value of goods and services a country produces. When GDP is growing, it usually means businesses are making money, people are spending, and jobs are being created. If it shrinks, that's a red flag for recession. But here's a tip. Don't just look at the headline number. Pay attention to the growth rate and whether it's accelerating or decelerating. A slowing growth rate, even if still positive, could signal that the economy is losing momentum. Next up is inflation, often tracked by the Consumer Price Index, or CPI. Inflation tells us how fast prices are rising. A little inflation is normal, even healthy. But when it starts to run hot, like what we've seen in recent years, your purchasing power takes a hit. Suddenly, the same paycheck buys less gas, less food, and fewer of the things you need. Smart investors track inflation closely because it impacts interest rates. Which brings us to another key indicator. Interest rates, set by central banks like the Federal Reserve. When inflation rises, central banks often raise rates to cool things down. Higher rates make borrowing more expensive and can slow down spending and investment. Now let's talk about unemployment. High unemployment usually means the economy is struggling. Low unemployment? That's great. But it can also push wages up and add to inflation. It's all a balancing act. And here's where it gets interesting. These indicators don't work in isolation. They interact. Think of it like a puzzle. For example, if GDP is rising but inflation is also rising fast, the central bank may respond by increasing interest rates. That could slow GDP down again. It's a cycle. Then there's consumer confidence. This one's often overlooked, but it tells you how optimistic people feel about the economy. When confidence is high, people spend more. When it's low, they hold back, which can drag the economy down even further. That makes it a useful leading indicator. It can hint at where things are headed before the data shows up elsewhere. Let me give you a real-world example. In early 2020, consumer confidence started dropping even before unemployment skyrocketed. Smart investors who watched that trend had an early clue that trouble was coming and could position their portfolios more defensively. Here's a quick critique, though. Not all economic data is timely. Some reports are monthly, others quarterly, and some are even revised later. So while these tools are powerful, they're not perfect. They lag, they adjust, and sometimes they even contradict each other. That's why context matters more than isolated numbers. So what can you do with this info? If you're a long-term investor, you don't need to panic every time inflation ticks up or GDP slows. But being aware of the overall trends can help you adjust your strategy. For example, during periods of rising rates and high inflation, value stocks or dividend-paying companies might outperform growth stocks. If you're budgeting or saving, watching economic indicators helps you anticipate changes. If unemployment is rising, it might be time to build a bigger emergency fund. If inflation is high, maybe you stock up on essentials before prices climb further. And if you're just starting out with investing, this knowledge helps you filter the noise. You won't be swayed by every headline or hot take because you'll have the tools to think for yourself. Remember, The goal isn't to become an economist overnight. It's to become a more informed citizen of your financial life. So here's my challenge to you this week. Look up one current economic indicator, maybe inflation, maybe unemployment, and ask yourself, what does this mean for my money? Just that one question can shift your mindset from reactive to proactive. If you found this helpful, hit that like button and consider subscribing.